Today, we are going deep. We're tearing open the 2025 annual reports for two absolute titans of the automation world, ZBRA Technologies and Diebold Nixdorf. And we're doing it to answer one big question. When you strip everything back, which one of these giants is actually built to last? Let's get into it. You see, both of these companies are at a huge crossroads. They're in a mad dash to evolve from just being hardware makers into becoming these all-in-one AI-powered solution providers. So their 2025 performance, that's our main exhibit. The real question is, as we dig through all this data, who's actually pulling ahead in this race?
All right, so here's how we're going to break this all down. We've got 6 chapters. We'll kick things off with their turnaround stories. Then we'll dissect their growth strategies, pop the hood on their financial stability, see who's winning the AI arms race, uncover something the market is totally missing, and then finally, we'll give you our 2026 investor verdict.
So let's dive right into Chapter 1. The year 2025. This was supposed to be the big pivot year for both of them. And the goal was identical. Stop being just a hardware company and start dominating this new world of AI solutions. But as we started digging into their official 10K filings, two completely different stories jumped out at us. I mean, polar opposites. On one side, you have this incredibly aggressive, debt-fueled expansion, just a massive bet on the future. And on the other, a really quiet, almost fragile recovery from a major corporate restructuring. These two are not on the same path at all.
And that brings us to Chapter 2, where we can see exactly how these different paths are playing out. Let's look at ZBRA's playbook for growth. In 2025, their strategy was simple, and it was aggressive. Buy your way to the top.
And I mean, ZBRA really went on a shopping spree. They threw down over $1.3 billion to snatch up Elo, which is a huge name in self-service kiosks, and Photoneo, a leader in cutting-edge 3D machine vision. Now, this wasn't just about getting bigger for the sake of it. No, this was a calculated move to capture these new high-growth markets and basically own the future of automation.
Now check this out, because this is really interesting. You can see how their empires are split geographically. Diebold is an absolute fortress in Europe, the Middle East, and Africa. That's where more than half their revenue comes from. ZBRA, on the other hand, is your classic American-focused powerhouse. So they're not even really fighting the same war on the same battlefield.
Okay, so that brings us to Chapter 3, stability. Because aggressive growth is exciting, but the real question is, can the company's finances actually handle that kind of strain? It's time to pop the hood and take a hard look at their balance sheets. So first up, let's look at Diebold Nixdorf. They're pretty fresh out of a big restructuring, and their net debt is sitting at a pretty reasonable $563 million. Just keep that number in your head for a second. Because now, look at ZBRA. Their net debt is nearly $2.4 billion. That aggressive growth plan we were just talking about, well, this is the bill. And it immediately paints a way, way riskier picture. The difference here is just, wow. And this chart just hammers home that difference in risk. What we're looking at here is financial leverage, basically how much debt they have compared to their earnings. Diebold is sitting at a very calm 1.5 times. ZBRA, on the other hand, fueled by all those acquisitions, is leveraged way up at 2.7 times. That's the price of their strategy, right there in one chart. But hold on, because this is where things get really interesting. See, on the surface, ZBRA actually looks a bit safer. They have a better interest coverage ratio, which means their earnings can cover their interest payments more easily. But the devil is in the details, and the detail here is the type of debt. Diebold was smart. They locked in mostly fixed-rate debt. Their payments are predictable. ZBRA? They're sitting on $2 billion of floating-rate debt. That is a massive gamble. If interest rates were to spike again, their payments could explode, and that would put a world of hurt on their profits. All right, on to Chapter 4. This is the big one. This is where the future gets decided, the race for the AI crown. We're going to compare how each of these companies is spending their money to innovate and try to win the tech arms race. And honestly, the numbers here tell the whole story. This isn't even a contest. ZBRA poured a massive $593 million into R&D. That's a full 11% of their revenue. Diebold, by comparison, spent just under $87 million, a tiny 2.3%. This tells you Diebold is basically in maintenance mode, just keeping the lights on, while ZBRA is in full-on pedal-to-the-metal innovation mode. And you can see that spending gap reflected in their strategies.
Zebra has this huge, sweeping vision. They want to use things like AI, edge computing, and 3D machine vision to digitize every single frontline operation out there. Diebold's goal is, well, it's a lot more focused. It's defensive. They're using AI to make their existing retail and banking hardware a little better. It's pretty clear. One is playing offense, the other's playing defense.
And now for my favorite part, Chapter 5, the HDIN Edge. This is where we go beyond the flashy headlines and dig deep into the footnotes of the 10K filings, to find the hidden risks and insights that almost everyone else is probably missing. Okay, first, we got to get a quick definition out of the way. It's an accounting term called Goodwill. So, when a company buys another one, any money it pays above the fair market value of the assets gets recorded on the books as Goodwill. Just think of it as a multi-billion-dollar IOU that represents a bet on the future success of that deal. And here is Zebra's bet, a jaw-dropping $4.7 billion of its assets. That's more than half of its entire balance sheet is Goodwill. This is what we at HDIN call a gray rhino. It's a huge, obvious risk that's just sitting there, but people tend to ignore it. Because if those big acquisitions don't work out like they planned, Zebra could be forced to write down billions of dollars, and that would absolutely crush their profits. Now let's switch over to Diebold's hidden risk. It's hiding in plain sight in something called fresh start accounting. It's a special rule that companies get to use when they come out of bankruptcy. It basically lets them hit the reset button on the value of all their assets and liabilities. The slate gets wiped clean. But here's the catch, and this is the critical insight. As our own research points out, fresh start accounting can be used to make a company look a lot healthier than it actually is. By playing with the asset values on that fresh start, a company can lower its future depreciation costs, which, you guessed it, artificially inflates its profits. So, Diebold's impressive recovery, it might be more of an accounting trick than a real business turnaround. Okay, so all of that brings us to our final chapter, the 2026 investor verdict. It's time to pull all these pieces together and lay out the clear case for and against each of these companies. So here it is, the whole story side by side. For Zebra, the thesis is simple. High growth, but high risk. The dream scenario, they completely dominate the future of AI automation. The nightmare, a catastrophic Goodwill write-down blows up the balance sheet. For Diebold Nixdorf, the story is a stable recovery, but with pretty low growth. The upside is some real financial stability from that fixed-rate debt. The risk, that the recovery we're seeing is just an accounting illusion hiding a business that's not actually growing. So when it comes down to it, the choice for 2026 is this. Are you betting on the aggressive sprinter who's moving at an incredible pace but could trip and fall at any second? Or are you putting your money on the recovering marathon runner who's slow and steady but might not actually have the energy to finish the race? And that's the core of what we found. If you want the full, granular, deep dive analysis with all of the supporting data from those 10K filings, you can download the complete PDF report right from our website, HDINresearch.com.